Welcome back to this class. Here we are going to focus on insurance in international business transactions. Remember, we said whenever the Incoterms are employed, whether CIF or FOB, it is pertinent that the seller or the buyer, they carry out insurance to ensure the goods from damage. So in this class, we are going to focus on what exactly is this insurance that we're talking about, and what are they insuring, what are the policies. It's not going to be a lot of detail on the law of insurance because this class is principally for business students, not law students, but we're just going to cover basic knowledge and basic principles on insurance when they're insuring goods en route from the seller to the buyer. So when we talk about a contract of insurance, we are saying that one party, who's usually the insurer, for example, you have UAP or you have AIG, any of the insurance companies that you know, Swico, any of the insurance companies that you know, they insure someone else, the buyer, to make sure that the goods that the buyer is bringing in are protected. So by insurance here, we're talking about a device by which an insured person, that is you the buyer, you protect yourself from heavy loss that is likely to be caused by any uncertain event that could happen to your goods while they are coming to you from the seller, and this you do it by paying a small price that we call a premium. So you find, for example, if you're bringing in your car from Dubai, you will have to insure this car, and you pay a small amount of maybe $200. I'm just using an educated guess. You pay about $200 for that insurance, for insuring the car. But it means that if that car is destroyed maybe on the high seas by pirates, or let's assume there's a fire and the car is destroyed, the insurance company is going to protect you, and they'll compensate you for the loss of your car. So this is really the insurance that we are talking about. So let us start by first looking at the key terms in insurance. These terms are important for you to understand the principles on insurance. When we talk about an insurer, we are talking about the insurance company that is insuring you. For example, AIG or statewide insurance company, the person who promises to compensate you in the event of loss. And if it is life insurance, that person is called an assurer. If it's for water or marine insurance, that person is called an underwriter. So the insurer is the person who promises. The insurance company basically is the insurer. And the insured person is you, the person who's taking out the insurance. You, the buyer who wants to protect your goods, or you, the seller who's protecting goods on behalf of the buyer. You are the insured person. The insurance policy is the document that contains the terms and conditions of the contract of insurance. What is it that shows that there was an insurance contract between the two of you? That's the policy. And the premium is the amount of money you pay for this insurance policy. Like in our case of the car from Dubai, the $200 is the premium, the amount of money you pay. The subject matter of insurance is what are you insuring against? Is it fire? Is it theft? Is it what kind? I mean, the subject matter of insurance is what are you insuring? What property is it? Is it cargo? Is it goods? Is it a car? So what is the subject matter? What are you insuring? That is the subject matter. Insurable interest, we are saying you must demonstrate that you have a financial interest, or what we call a pecuniary interest or proprietary interest in the subject matter, in the goods. So you must demonstrate that you have a reasonable financial or ownership, basically legal ownership in what is being insured. That's what we mean by insurable interest. So what are the different types of insurances? We're just going to focus on two major types. There's life insurance and there's general insurance. Life insurance is really talking about you, the insurer, taking out a policy that in case you die, they'll give the money to someone in your, maybe your heir or your administrator or your successor. So for life insurance, you're taking out insurance against your life. And you do this by paying a small premium every month or every year, so that whenever you die, your family is entitled to a specific amount of money. That is life insurance. General insurance, on the other hand, is now the insurance we are talking about when we're talking about sale of goods. When you cover goods, or you protect property, or you protect all these other things, that falls under general insurance. And this could be maybe you're protecting you from motor vehicle theft or burglary, stealing your things in the house, or water, marine insurance when the things are en route on water, on the high seas and they're coming in. The kind of protection you take out on that is what we call the general insurance. So really two major types: life insurance and general insurance. But in this class, we really focus on the general insurance. We're not talking about life insurance. So let's look at the general insurance. So when we talk about general insurance, here I'm going to describe briefly the different types of general insurance that the types that exist. Fire insurance, they're insuring you against fire. In case of a fire outbreak and your goods are caught by fire, the insurance company is supposed to compensate you because you took out insurance against fire. If it's marine insurance, here the insurance company, or what we call the underwriter, promises to pay you a certain amount of money that is as a result of the marine damage. Maybe the ships, there was a collision of the ships, maybe there was a tsunami or a storm and goods were damaged. Marine insurance covers that. Water insurance, basically insurance on water. Hull insurance, number three, on the other hand, is protecting against the ship. The ship owner takes out insurance to cover his vessel because these ships cost so much money to build. So the owners of the ships take out insurance to protect them, to be indemnified in event that their ship is damaged. And here we are really talking about furniture, fittings, the machinery in there, the engines, but not the things of the crew. They take out insurance of the ship itself. So still under types of insurances, we have what we call cargo insurance. And here cargo insurance, you're really insuring the goods, the cargo itself from, for compensation. So you pursue the insurance company to compensate you if your cargo is damaged because you carried out cargo insurance. This is typically the kind of insurance that most Incoterms are taken out for. Freight insurance, here the shipping company insures the freight process because sometimes they fail to deliver what they're supposed to deliver or things are lost halfway. So the law enables them to seek compensation if they are not paid because they didn't deliver what they were supposed to deliver. So this freight insurance is usually taken out by the shipping company to insure against loss in the event that the company is not paid for the freight or the transportation of the cargo. Third party liability, here we are saying that you, a third party, can claim compensation. For example, if you're in a car and a car is involved in an accident, you, the third party, can claim compensation from the insurance company of that car, you as the third party. So it can be usually for collisions or any kind of damage that happens while you're in that car. Theft and burglary. Number 7, we're talking about protection from theft or burglary. In case you have, for example, your car, what they call comprehensive. Your car, if there's something is stolen off the car, you're entitled to be able to claim compensation from the insurance company to replace that which has been stolen from your car or from your home or from your house. Now I want to talk about the different marine policies. What kind of policies are taken out? What kind of water? Marine, we're now talking about on the high seas, water policies are existing. One of them is called the voyage policy. And here the cargo, the subject matter, that is the ship or the cargo, is insured only for a specific voyage. For example, if the ship is supposed to move from Dubai to Mombasa, and the insurance that is taken out, it will be insurance for the entire journey up to Mombasa. So it's a specific voyage policy. This is different from time policy, where you insure the goods for a specific period of time. For example, you know that during this time, maybe December, there are so many floods that the sea is likely to flood. So you take out a policy for that period of time in the month of December. That is what we call a time policy. Then the mixed policy is a mixture of both voyage and time. There's insurance covered for the time period of December for the entire ship process from when the ship leaves Dubai until it arrives in Mombasa. So that is another type of policy. Then the fourth policy, on the other hand, is covers the vessel for the period of time it's at the port. So these are just different types of marine policies that exist for your personal knowledge, really. Now, I want to talk about some key insurance principles. I want to define some of these key insurance principles because they govern the principles of insurance, how the insurance policies work. One of them is utmost good faith, and in this principle, we require that the insured person, the person who they are insuring, you must come clean on everything concerning what you want them to secure you for. Because if they find out that you are telling a lie, here we say when there's any false statement or half truth, you will not get your compensation. So the law requires that you act in utmost good faith. And by utmost good faith, we are saying you're putting everything on the table concerning the insurance you're taking out. Everything, you're coming clean on everything concerning what you're covering. Now, the principle of indemnity means that you're going to be compensated. Where a loss occurs, you, the person who has been insured, you have a right to recover from the insurance company. So indemnity means to be indemnified, to be compensated, to be made good, or to be placed back to the position that you were in before the damage arose. So these are just some of the principles, like I said, that insurance companies use when they're talking about taking out insurance on your behalf. Insurable interest, you must demonstrate that you have an insurable interest. We've already talked about this before, that you have at least a financial or an ownership or proprietary interest. So you must establish that you have an interest, a legal interest, a financial interest in what you're claiming insurance for. You cannot wake up and think you insure for your grandfather when you don't have any interest in that property. Causa proxima, it means that the insurer is only supposed to pay for loss that has been caused by the risk or the period insured against. Let's read this case so that you understand what this point is saying. So in Punk versus Fleming, in a marine policy, now this is a policy for water, things were on the seas. The cargo was of shipment of oranges, so they were going to insure oranges. And the peril or the problem insured against was collision with another ship. Now, during the course of the voyage, the ship actually collided with another ship, which created delay and mishandling of the goods of the oranges on the ship. And because of this delay and mishandling, the oranges got spoiled and they could not be taken by humans. Now, when the owners of the oranges tried to get compensation, the law says that the court said that they could not be compensated because the oranges did not get spoiled because of the collision. They got spoiled because of the mishandling. So there was no cause approximate. There was not approximate cause. This can be interpreted to be approximate cause between the damage that happened and the thing that you're saying created the problem. So in other words, the oranges were caused by the rotting is what caused the oranges to lose value, not the collision. So the law says there must be a direct relationship or a direct connection between the loss and the risk you are insuring against. Risk must attach. Here we are saying that the risk must occur. For example, if the insured goods arrived safely, even if there was a war or there was a flood, but your goods are not touched by that flood, the law says you cannot seek compensation. So you can only seek compensation from insurance once the goods have actually been damaged or once the risk has actually been seen and identified and happened. So the premium cannot be covered from insurers where consideration of because the consideration has totally failed. There was nothing that happened to your actual goods. You didn't lose anything. So you cannot claim compensation. Mitigation of loss, another insurance principle. The law requires that when something happens to your goods, for example, the oranges we talked about, if you realize that I insured these oranges but they're actually getting spoiled, the law says you must mitigate loss. You must take out all reasonable actions and either sell off the oranges or give them to people for value. Basically, try to minimize the loss as much as possible. And you're entitled to claim the amount of money you use to try to minimize the loss. But if you don't minimize the loss, the insurance company will not compensate you where you are negligent and you just sat back to let the loss happen. So mitigation of loss means you must control the loss. Once you identify that loss is happening, try as much as possible to control what is the damage that is happening. That's what minimizing loss means. And the final principle, I'd like to talk about is subrogation. Here we are saying that you see when a damage happens in insurance, you the person who's been damaged, who's facing the damage, you're entitled either to sue the insurance company or to sue the person who's created the damage for compensation. So the law is saying here that you can choose one of the two. You can't choose both because you can't gain, it's called unjust enrichment. So whoever you choose to gain compensation from, it could be that you've chosen to get it from the insurance company. Now, the law allows the insurance company to also pursue the third party who created the damage in what we call subrogation. So insurance companies have the right of subrogation. They can go after the third party code who brought about the damage and claim compensation from you, from them, for the money they've given to you as indemnity. So I hope these principles on insurance are clear. Like I said, they are really basic principles. We're just scratching the surface for business students so that you understand the insurance aspects involved in an international business transaction. When you're buying goods by CIF contract, you're buying them so that from wherever you're buying them and you're required to insure those goods. These are the basic principles you need to know for purposes of insuring the goods. Thank you for watching. Have a good day.